Hello, everyone. I'm Milan Handelsman, National Sales Manager for Raintree Financial Solutions. And today I'm delighted to be joined by Gerald Tkach from Millennium 3. Raintree and Millennium 3 have been working together for many years. Millennium 3 is a real estate offering with a tax twist. What we're going to do today is Gerald's going to run through about a 30-minute presentation describing the company, the history, their offering structure, and they're discussing a bit about their current offering. If you have any questions during this call, please type them into the Q&A window. You'll find that by just scrolling to the bottom of your screen and click on that Q&A tab. I will be monitoring the Q&A, and at the end of Gerald's presentation, I will ask those questions. So thank you very much, Gerald. Welcome, and over to you.
Awesome. Thank you very much for having us. Yeah, we've had a great relationship with Raintree over the years, and I think we're one of the longest standing products on the shelf. So this is just the next step in that. And we certainly appreciate the opportunity to share with the world what we do and how we do it and the current offering. If you like what you hear today, we always talk about the current offerings and whatnot. We're a company that does a number of offerings per year as opposed to one large capital raise. So the current offering is dated, the OM is dated March 15th, 2021. A lot of what I will be telling you about today talks about the Millennium Group as a whole or our investment model, because I think that's important to investment making decisions, is that what we do is a consistent kind of product, whereas the property itself might change and who the tenants are, the model doesn't change. I will get into the specific offering because, again, if you are interested in investing, it is good to know what you're investing in. But you'll notice that the presentation has that twofold approach of talking about the model for the first bit and then the specific offering. Always good to get the disclaimers out of the way. This one just covers off that there is some forward-looking financial information. So what we say is we've got 40 years of experience in real estate and this type of real estate specifically, but we don't have a crystal ball. So we're making projections going forward, but we don't certainly know the outcome of the next 15 years exactly. The others have their statutory rights. So you have an investor do have rights. So it's important to consult the offering memorandum to review those. So this slide is my Millennium in a nutshell slide. So if you've never heard of Millennium, these are the main takeaways that I think an investor should end up having after a presentation like this, or even just an introductory conversation with their dealing representative. The first is that it's a commercial real estate investment. So what that means is small office property, a retail mall, an industrial property, that's commercial for us. We differentiate because not an apartment block or hotels or anything like that. Ours is existing commercial real estate. And the way we own it is similar to a rental property, right? So the way most people own real estate as an investment outside of their primary residence would be to, buy a half duplex or a small single family home, and you buy it with a mortgage and put down a down payment. You have a tenant that lives there, pays you rent, you take that money in, pay off your mortgage, and one day it's debt free. So what Millennium does is a similar business model, the way most people own that type of real estate, but we apply it to commercial real estate, which is typically out of the reach of the average investor. Now, the next step is that we purchase growth-oriented properties. So we don't want things at their highest and best use. You'll notice that the Millennium properties are those little bit fixer-uppers. So again, I make a lot of comparisons to residential real estate, but this is that home and garden TV where you buy the least good-looking property in an up-and-coming neighborhood and you fix it up and spruce it up, and now it's a great-looking property in a great neighborhood, right? So that's the idea of what we do. We're not looking for things that are 2 years old, just built, everything's glass. That's not what we're looking for. We're looking for the property that's been around 20, 30, 40 years, needs a little bit of TLC, and then we spruce it up and hold it for the long term. Now, one of the main reasons that we look for that property that needs some TLC is that's partially where the tax deduction comes from. So we're a tax advantage investment. So a lot of our clients are looking at us for tax planning purposes. And the idea is that the costs associated with doing the refurbishment to the property can be written off by investors, primarily in the first year of their investment, but some additional in subsequent years. But that adds to that tax planning component. So again, relating it back to residential, it's like if you owned a rental property and you painted or you did new carpets or cupboards or whatever the case is, you'd probably keep those receipts and then you can deduct them against your personal income for expenses of the property. So this is, again, different section of the Income Tax Act, but a similar kind of model of we're putting money back in the property to brighten it up, spruce it up, make it better, make it more leasable for tenants, but we get to deduct it. And the final piece is that we're an income producing investment. So again, different than the kind of home and garden TV type conversations. A lot of those, especially in residential, is you buy it, you fix it, you flip it, right? Ours doesn't work that way. We actually intend to hold these as a revenue producing investment. So it's designed to be that revenue producer that complements an RSP portfolio or some other kind of retirement investments like pensions and whatnot. So we actually want to hold these investments, and we do hold many of them for 20, 30, 40 years, right? So that's the design, is that instead of buying it, fixing it up and flipping it, we actually buy them, fix them up, and then ride them off into the sunset for income production. So it is the long-term portion of somebody's investment portfolio as opposed to a 5-year we get in, we get out. And it just is related to how commercial real estate works with more long-term leasing and whatnot. So to give you a bit of background on Millennium, we started in Saskatoon in 1981, so that we've been around for that 40 years. We changed our focus to commercial properties in 1987. So you've already heard 3 or 4 references to residential ownership. It's because we know it. The first 7 years of the company were buying and kind of similarly leasing out and renting residential apartment blocks. But from 1987 to today, so 30, 33, 40, 34 years, we have been solely commercial real estate. Now, that doesn't mean we got out of those original residential properties. We held many of them for 30 plus years. So we were able to really compare and contrast the 2 types of investment strategies. And we just felt for our buy, fix, and hold long term, commercial has a number of advantages that we wanted to focus on. So it doesn't mean that there's not money to be made in residential. It just means for our particular business model, we think commercial is the better investment. Now, the next major change in the company is that we shorted the mortgage lives to between 10 and 15 years in 1995. So from 1981 to 1995, these were actually 25-year mortgage amortization. So again, it was very similar to owning that rental property, right? If somebody buys a house, if they put 20% down payment, they're still probably working on a 25-year mortgage amortization. That was the model back in the 80s and 90s. It was actually feedback from investors where we had a lot of discussions that investors got a little bit more cash flow throughout the investment, but again, taking that 25 years was a long time for people to wait for their investment to mature. So our investors said, we're working, we love the tax advantages, don't get me wrong, but because we're working, we don't really need the income stream for those, first however many years until the mortgage pays out. So we revamped the model so that we can pay the mortgage off in kind of a pretty advanced fashion, get it paid out in that 10 to 15 years. But the trade-off is there's not as much money produced in the 10 to 15 years, right? But again, that kind of suited most of our investors because they had other investments that were providing yield at that time, or as I mentioned, many of them were still working, so they had their employment income to rely on and keep everything as they needed it. The final change or next advancement of the company was we began acquiring properties in Alberta in 2005. So previous to that, they were all in Saskatchewan, specifically the Saskatoon area. So now we've got about 1/3 in Alberta and 2/3 in Saskatchewan. The current offering that you'll hear about is a Saskatchewan property. Now, again, that experience, about 66 commercial properties that we still manage on behalf of investors, one of the largest commercial landlords in Saskatoon, 25 completed projects in Alberta, and about 350 million of assets under management. Over the years, there have been properties that have sold. Again, the original residential apartments are all now no longer in the portfolio, and even some commercial properties have sold. So that is about $100 million that has sold over the years. Over that 40 years, we've amassed nearly about $500 million of assets, but again, 350 million is still under management today. Just types of properties. So as I kind of mentioned, there's retail, office, and industrial. So this is what a retail property is to us. These are all Saskatoon properties. So if you're not familiar with Saskatoon, you may not recognize them, but this is a few restaurants, a hairdresser, a dry cleaner, there's a medical facility, a gas bar. This is a retail property for us. This would be office. Now, again, the main floor is arguably a little bit more retail, but the second floor is primarily Wawanesa Insurance broker here in Saskatchewan. Again, they use it for office. And an industrial property. So industrial is interesting. I like it. I call it a hidden gem because people don't realize how different industrial is from retail. Is tenants in these spaces, it's very functional, right? They don't care about passing traffic. Some of them, if my cursor shows up here, you'll see like they don't even have a sign can to show who the tenant is there because they don't have that retail presence. They're a logistics company or they don't need people coming to them or knowing where they are. They just want, is it functional? Can I get a forklift in the back? Does it have Docker grade loading? Whereas if you can get tenants in there, get them happy and keep them happy, they just stay. As long as their business is viable, they stay quietly, and that's exactly what we want. 1,600 investors in our group who hold 5,700 limited partnership units. So it's about 50% repeat investment. So a couple things I like to point out there. So the average investor has somewhere between 3 and 4 units. Now, again, it's all about suitability. So for some clients, 10, 15, 20 is an appropriate amount in their investment portfolio. And for some clients, it's 1. And we welcome both. The idea is that working with your dealing representative is how you can figure out what may be appropriate for your personal portfolio. And the other side of it is 50% being repeat investors. That's actually really a 40-year number, right? We look back at the entire portfolio. Now, a $20,000 or $25,000 investment was a lot larger portion of somebody's investment portfolio in the early 80s and 90s, whereas with just time value, money, inflation, all that sort of thing, it's just not as big of a portion anymore, right? The purchase price is still in that range. So what I did is I looked back at the properties from 2015, right? So about 5 years ago, give or take, and I said, how many investors that year, whatever they invested in 2015 was either not their first investment with us, so it was their second, third, fifth, 10th investment, or if it was their first investment, how many invested again in the next 5 years? And the number came out to 83%. So it speaks to the investment being typically part of a portfolio plan. It's not a one-off purchase for most investors. It is an interesting opportunity and unique in a lot of ways, but for a lot of clients, it's I want to allocate this much of my investment portfolio to this investment strategy, and I'm going to spread that amongst 2, 3, 5, 10 investments to get some diversification. So we do see that, especially on the tax planning side of it, a lot of our investors invest 1 year, and then especially if they're tax planning the following year to get some diversification, but also get that reoccurring tax planning benefit. I like to point out that the principal is purchase units in every limited partnership. So this is done from an alignment perspective. But what that means is I get to go into my boss's offices a couple times a year, and they write checks just like every single other investor. So there's no discounts, there's no any sort of benefit to them. They're buying investment units just like every single other investor. So from an alignment, their money is on the table right next to yours as the investor. I do like to touch on our corporate guidance for a couple minutes because I think it is something that is unique, not just in kind of the private space, but possibly the public space as well, is the kind of commitment from our management team. And you'll understand what I mean in a couple minutes. The first is that the ownership family, the gentleman that started the company is Everett Kearley. He's the founder and chairman of the board, still active in the organization, but in a kind of that kind of bigger picture umbrella management advisory position. He's in his early 80s, but active in mind, body, and spirit. And previous to COVID-19, he was in the office 3 days a week and worked from home the other 2. He's really that person that being the founder, what he doesn't feel like work to him, so he continues to do it because he enjoys it, right? And that's a fantastic person to have at the helm, so to speak. Now, his son, John Kearley, is the active president. So this is more that day-to-day management. So the two of them provide certainly the umbrella management and that kind of, cohesive voice and consistency. But what I like about it is John has been with the company in a full-time capacity for 27 years, right? So this isn't a matter of Everett wanting to retire, looked around to find the nearest family member and said, here you go, please don't break it. John has certainly been actively involved in the company, worked his way up. He started on the job sites, sweeping up, hammering nails, doing that kind of stuff, and further involved in the company. He's been the acting president for a number of years now, and the two provide the umbrella management. So that's something that isn't necessarily, there's lots of long-term multi-generational companies. That's a great thing to have. Now, where I think we're a little bit set apart is with our corporate guidance, it's the same people doing the same thing. And you get good at doing it when you've done it that many times. And for me, there's an advantage of Millennium 3 is that it certainly does not have that revolving door of always new people coming in, having to figure things out, making mistakes. We really do have a very consistent management team that is producing a consistent product. So Alan Lebejak is our first vice president. He's a VP of accounting. He's been with the company for 28 years. So again, that's not an accountant for 28 years. It's not bounced around between 3 or 4 companies that all do the same thing. He's been with Millennium 3, being in charge of our financial statements and our financial reporting to CRA, all those sorts of things for 28 years, right? That's how long he's been with the organization. So again, he's got to be one of the experts, if not the expert on limited partnership taxation in Western Canada. Mike Laliberty has been with us for 18 years. Now, Mike is one person that I do like to talk about their industry experience because he's got 43 years in total of industry experience. And what that is, being the VP of operations, is property management and leasing. So again, this is that day-to-day dealing with tenants. We've got about 500, 550 commercial tenants that we deal with. It's all that kind of interaction, and he's at the helm of that. Now, the reason I point that out is Mike is still a fiercely loyal person. In that 43-year career thus far, it's been 2 different positions at 2 different companies. The other company is a Saskatoon-based landowner and commercial real estate owner, and we were able to steal him 25 years ago. So his first 25 years of his career were with that company, and the last 18 have been with us. So again, he knows every game a tenant's going to play before they play it themselves. He's the fantastic person to have on our side of that interaction. I'm a vice president. I've been with the company for 19 years. I won't spend too much time talking about myself. And Jarvis Ryan is our CFA VP of Finance. He's been with us for 18 years. And again, so Jarvis is in charge of all the offering memorandums, the mortgage work, and doing a lot of the financial analysis behind the scenes. So again, a fantastic vice president level management team that average, the shortest tenure is 18 years, the longest is 28, and it averages to be about over 20. So again, very significant in that way that it's the same people doing the same thing. From my perspective, if somebody invested 10 or 15 years ago and they want to pick up the phone and ask questions, they're still calling me because I was there then and I'm still there now, and I'll still be there another 10 or 15 years from now down the road. It's important to note that there is an independent director for the offerings as well. So the gentleman is named Daniel Bollinger. He's a CMA CPA, Director of Financial Services for Sask Water. So if you're not familiar with Saskatchewan, it's a relatively important crown corp around here. And again, he's got expertise in both the public and private sectors of about 20 years. This is that person always looking over the shoulder on the investor's behalf to say, are you doing what you say that you're going to do? Now, the structure, as I mentioned, has been consistent over a number of years. Once you sit down and attend a presentation like this or dig into some of the offering documents, the main takeaways are consistent from property to property and year to year. So the investment cost is $24,700. Now, the year that you invest, as I mentioned, you typically get about a $12,000 tax deduction. So again, roughly 50%, give or take. And that primarily happens in the first year and is part of the setup and the kind of refurbishment of the property. Now, the mortgages on the properties are typically paid out about 14 years after initial syndication as they stand today. And the long-term kind of income producing side of it is the second point on the slide, that once all the dust settles on the next 15 years, based on the projections that we have and the growth expectations, each of those $25,000 investment, or sorry, I should have qualified that. I sometimes, for ease of conversation, will say $25,000. Now, the actual check that everybody writes is $24,700. There's a long raising capital in Saskatchewan reason why, but if you catch me saying $25,000, that's exactly what I mean. I apologize for kind of being a little bit loose with that, but each of those $24,700 investment units is anticipated to produce about $5,000 of net rental revenue per unit per year. So that's that income production, right? So now there's still has to be annual expenses pay out of that, but the vast majority of that, once the project pays out, will be distributed to investors. Now, what we point out is that annually per unit that's effectively what happens in year 15, right? So from years 1 to 14, if everything goes according to plan, there's still typically, about $400 per year that goes out to investors. The equivalent of a blue chip company or something like that produces a small dividend to show that, we're doing what we're supposed to do and everything's working, but not enough to detract from paying off that mortgage in an advanced fashion. Now, the other piece is that, again, as I described, if everything goes according to plan, this is what it looks like in year 15. But the idea is that we're going to continue to hold these as an income producing investment. So that'll be consistent for year 16, year 17, year 18, year 19, year 20. But also keep in mind that as rents continue to appreciate, which they typically do, the payouts to investors can grow as well, right? So some of our earliest investments from that kind of 1995-ish era have produced well over the $5,000 now that they're in their kind of 20th, 25th years of operations. So now switching into the current offering. So again, if you like what you hear, you want to hear about the current offering. This is the offering itself, Northwest Place. So I mentioned it's a property in Saskatoon. Now, how the investment itself is structured, it was started in November of 2020 at 116 total units. So 69 of them sold before year end. So what happens then is the remaining 47 are offered as Finley Properties 2 limited partnership, and the 2 partnerships together hold the property. So regardless of which property you invest in, you are 116th owner for each limited partnership unit that you purchase. The difference is which year you get your tax deduction. So for clients that bought in 2020, they got their tax deduction, they did their taxes, they got a refund, life is great. For clients that are buying in now in 2021, they will get a 2021 tax deduction for their upcoming tax return. Now, the principals and vice presidents purchased about 9 units between those 2 partnerships. And it's important to point out that it's non-registered funds only. So again, if you do have RSP investments, maybe they're in a mutual fund that you feel is unperforming, you want to move them to something else. Unfortunately, we can't accommodate that. We're only available for open money. We aren't available for any non-registered funds. The property is about 36,000 square feet. It's an industrial and office, and it has 94% is the current occupancy. What I like about the property is that it was actually built industrial. So all the bays in the back have big loading doors and whatnot. But this is that kind of functionality, is that many of the uses in the property are smaller offices, right? So the idea is that From an owner's perspective, if there was ever a one sector high demand and one sector low, any of the spaces could be effectively flipped between the two. You always have to go in and refurbish and whatnot, but an office space could certainly be converted back to an industrial space, and vice versa. Any of the industrial spaces could be converted to office space with some tenant improvements. If you're not familiar where the property is in Saskatoon, but you are familiar with Saskatoon, this is our airport, and we're just up here in the airport industrial area. And giving a bit of a Google Map overview. So again, this is the south part of the airport. This is the subject property. And interestingly, this is our head office right here. So we do have close proximity to managing the property. Now we own, 40 properties in Saskatoon. So we know the area quite well, but I could literally walk to this property in about 5 minutes. Interestingly, we also own this property here. We own another property right about here. So we own a number of properties in that area and know it very well. The reason that we like it, that property and that location is just, it's an established industrial neighborhood. It's got good demand for its product, its type of properties, and primarily maintains a high occupancy over the years that we've been in that area. Now, who the tenants are, we always caution tenants, again, our investors, it's your investment. You should know what you're investing in. And primarily, if there's tenants that are paying us rent, but we invest in good properties, not necessarily the tenancies in them. It's good to know from the start of investment who the tenants are, how long they've been there, what their history is, what their businesses are. But at the same time, turnover and changeover is just a day-to-day occurrence with us. Now, literally not day-to-day, but we deal with it, right? We don't expect that for the next 15 years, every single one of these tenants will be there the entire 15 years, let alone 20, 25, 30 years, right? But from the get-go, you might as well take on who's there and what they do and their viability, because that's still 10 or 15% of the investment decision should be the property itself, and here's who the tenants are. Orano Canada is one of the larger tenants. They are a uranium mining company in Canada. I've been here for about 50 years. They used to be called Ariba. They're probably second only to Cameco in Canada, and Cameco would be the world's largest uranium producer. Now that is an industrial space that they use there. Kinsman would be an office tenant, so they're a registered charity. They're probably best known for their telemedical in Saskatchewan, raises about $5 or $6 million per year to help out with kids with unique health issues and things like that with their medical treatments. And again, they've been there for probably 30 years, right? They're a long-standing tenant, and this is exactly what we'd like to see. That again, if we treat them well and they need office space, they're probably going to stick with us and be there for the foreseeable future. So we do take an account of who's there and how long they've been there when we buy these properties. Next, just who the rest of the tenants are, and the reason that I go through them a little bit quickly is most of the names aren't recognizable for most people, right? Paragon Alternative Medical, Midwest Claims, they are an insurance adjuster, bath fitter, Sheep Development Board, Paley & Associates Consulting. There's an accounting firm. These are the types of tenants that are typical for a smaller industrial and office property like this, right? It's the right tenant mix for the right property. Like, we're not going to see a Halliburton, for example, renting a couple thousand square feet on a regular occurrence from us. These are the types of tenants that you expect for this type of property. Now, just falling in line to give you the specifics of this offering, again, it does meet the criteria. The purchase price is $24,700. The tax deduction is about $12,685. There will be a little bit of offsetting income to that. So again, if I was doing my tax claim today, I'd still be using roughly about a $12,000 tax deduction. The mortgage is anticipated to pay out in about 14 years, and it meets that kind of about $5,000 anticipated net rental revenue per unit per year once we get it paid out. Now, to discuss current events with COVID-19 as it relates to the property and I guess Millennium as a whole, all properties are assessed and they're individual, right? Like, that's the limited partnership structure, is every one of them is a separate entity. So they are assessed equally on their own, but also managed as a portfolio. From the portfolio perspective, we said from the get-go, we're going to be there to help tenants where they need it. At the start of COVID-19, it was a little bit scary. Like, there was a lot of tenants that were just open one day and closed the other. And it really did take a lot of time for tenant supports to come in for the government level. So we said from the get-go that if a tenant was in good standing going into COVID-19, they've been a great tenant for 10 or 15 years, never missed a rent payment, never had an issue, if they're going to fall on hard times for a couple months, we will be there to help support them and keep them viable, because that's the number one way that we lose as a landlord. Is if you lose a tenant, they're probably gone forever, right? If you can keep them and help them weather the storm, they'll still be there when the storm's over, and probably there for a number of years into the future, because they'll remember the help that they got from their landlord. That really does help increase that relationship. We looked at rent deferral agreements, and a lot of what happened over the last year is we actually almost became business managers for the tenants, because we helped them through the government programs that were available. A lot of tenants did not realize the government programs that would be available to them, how to apply, any of those sorts of things. So that was our primary goal. Now, to that extent, we also said with new tenants, we will deal with somebody coming in. We'll give them 2 or 3 months of free rent if they're signing a 3 or a 5-year lease, because ultimately in the peak of the pandemic of lockdowns, you feel like your prospects of leasing a space aren't that significant. So to give away a little bit of free rent at the beginning is probably the greater good for the long term, right? So we have that two-step approach. And as a result, our overall portfolio occupancy actually increased about 5% through the COVID-19 2020 year, from February to February. With the property itself here with Northwest Place, all tenants are a going concern. I mean, they're all paying rent. We intend to work with all the tenants that require assistance. And again, it's been relatively well through the COVID-19. Our industrial portfolio has probably been the least challenged. Retail and office have had a little bit more. Office, again, I would say has done fairly well. There's some tenants that have to look at it downsizing for whatever reason, but most of them are recognizing that we've now weathered the storm and the work from home and kind of all proven that we can do it. Now it's just, do we want to do it, right? A lot of businesses are coming back and saying, maybe it's a little bit more flexible, 3 days in the office, 2 days at home, or whatever the case is, but a lot of them are still coming back to say, from a productivity perspective, we want to be back in the office. Now, I feel like I'm getting pretty close to my 30-minute estimate, but I'm going to say that we started, or Alon had a minute or two to talk at the beginning. So I'm going to steal about 3 more minutes and go over a couple more slides here, if that's all right with everyone. And it just transitions into why buy Millennium, right? So if you've taken in the information, it's a tax advantage product that has a long-term income stream, but here's really why investors are buying. It has that first-year tax deduction. We've got equity growth from years 2 to 14, and then cash flow beyond. We've got that open-ended arrow after 15 years because, to be honest, the idea is that we will hold these as long as they're commercially viable, producing income for investors, and that's what they want. We have no problem holding these things for 25, 30, 40 years as they're producing an income stream for investors. Now, the typical investor falls into one of these categories. Somebody who's 15-ish years from retirement, so they'd fall in that 45 to 55 category. The tax deduction at the front end is helping because they're working, they're in high income earning years, but they want to retire in 10 to 15 years as this property matures, right? That's the good timeline for them. Now, this surprises a lot of people. So, if anybody on the call is in this kind of 60 plus range, is that there's a twofold approach why our second largest buying category is actually 60 plus. It's people that are saying, I don't want to outlive my money. So I get that I'm investing now. It's going to mature perhaps when I'm in my early 70s or mid 70s, but I can still receive the income stream from this for the next 20 years until I'm 95 to either pay for my yachting around the world or cost of assisted living, right? So there's still a need for money when going well past kind of 60, and you can still invest that way. The other reason that people invest in this category is it's an intergenerational or a legacy investment within the family, right? So they're investing for themselves, saying, I might be using this investment until I'm 95, but if I did pass away at 75 or 80 and I'm really not getting all the benefit of this, my next generation will. So it passes to the next generation to hold it for that revenue producing asset. And a lot of our clients really like that as an investment strategy, so that they've worked hard, they've saved a lot of money over the years. They really do want to pass on wealth to the next generation, but they fear if they do it as just everything liquidated and cash goes to the next generation, it might not be invested that wisely. Some clients use things like trusts, but this is another way that you can pass on an asset that provides an income stream as opposed to just a pile of cash. The final age range that invests fairly significantly is that 35 to 40. So younger professionals earning good money, maybe that they haven't built the kind of net worth that is into the 7 figures or whatever, but they have got a good income. They want to shelter that. And the other nice thing is you don't need to be retired to collect checks and cash them and use the money, right? So for a client that buys at 35, 15 years to the cash flow, or the larger cash flow, I should say, at 50, somebody knows how to cash a check and spend money for sure, right? Whether it's paying for kids' education or just maybe that's getting another level of investment at that point. Those are the 3 age ranges that buy most. Now, the reason they're buying is tax changes, right? Millennium 3 helps with tax planning and tax relief. The current government actually brought in a top tax bracket. People forget that anything over 200,000 is now taxed at a higher rate. There's going to be a reckoning, so to speak, from a tax perspective of paying for the COVID-19 pandemic and all the government programs. And don't get me wrong, many of them were needed, but there was also a lot of waste as well. And ultimately, us as Canadian taxpayers are going to end up footing that bill at some point, whether it's 2021, 2022, 2024, 2026, it's going to happen at some point. And that's tax planning has become more prominent on people's minds. New retirement standards. So again, people are living longer. So I spoke to this a couple times, just a couple more slides, and then I'll turn it back to Alon for questions. But again, if anybody on the call is 65 today, congratulations, happy birthday. And your life expectancy, according to Stats Canada, is till 86, right? So you've got another 21 years of fun and adventure ahead of you. Some people may pass earlier, some people will pass later, right? So you really do have to set yourself up with income producing assets well past the day you retire. You want to make sure you don't outlive your money, and this is a good way to do it. Another study out of JP Morgan in the US said if both spouses are living to 65, there's a 47% chance one of them lives to 90. So you do want to make sure you have very long-term cash flow designs. And the last is just diversifying a portfolio, right? So a lot of our clients, as I mentioned, maybe the way they own commercial or real estate is residential, that they want to diversify into commercial and build their portfolio. As I mentioned, we're not shy about being a long-term investment company and investment strategy, but it is part of a portfolio. So we wouldn't recommend that you don't have short-term public funds and medium-term investments with growth strategies and whatnot. We just look at that portfolio approach as this is one way that we can add commercial real estate into an investment portfolio. Harvard, Yale, OMERS have all done it increasingly over the years. CPP is another good example. Now, to be honest, all 4 of those, full disclosure, have not invested in Millennium 3 or LLPs. We're far too small for them, but it's the idea that they're investing into investment strategies that are very consistent and similar to what we do. So if CPP is supposed to be there as a Canadian to take care of me down the road and all of us down the road, and why can't I deploy similar investment strategies to take care of my own financial future? So just with this last slide, and then I'll turn it back to Alon, the CPP's assets, back in 1999, there were about 36 billion invested entirely in government bonds. It's changed over the years to now include about 23-24% of real assets up to 2020, which would include real estate assets. So it's significantly grown in that way. So thank you very much for giving me that extra little bit of time. I feel like I stole a couple minutes there, but hopefully it was very informative for everyone.
No, that's great. Thank you so much. Hey, Gerald, can you just put that last slide back on? Because I want to touch on a very important point to Raintree Financial Solutions. So we are an exempt market dealer. Our fundamental job is to establish strong suitability between our clients' specific financial situations and investment needs, interests, goals, and objectives, and those of the different companies for which we raise capital. And so we're very careful when we compare investment portfolios for pension funds, Canada Pension Plan, and others. Harvard and Yale endowment are often used as comparisons. We're very careful because those institutional investors often have different investment objectives, different sophistication levels, different goals and objectives to you or me as individual investors. And so what we do as advisors for Raintree Financial Solutions is we help our clients understand what their goals and objectives are. We listen, we learn, and then we make suitable recommendations of different offerings, including Millennium 3, if and where and when appropriate. So thank you very much. Folks, I appreciate you all attending the call. We still have a few minutes left. I'd like to invite you to go down to the bottom of your screen and click on that Q&A box. Add any additional questions in. I'm going to start with a few right now, but please do add to those questions. Gerald, you guys have been around for a long time. You've raised a lot of capital through limited partnerships over a number of projects. And one of the questions comes in relates to, you referenced 95 properties that have seen rent grow over the years and are now producing cash flow for those investors. But what about COVID? Have we seen rents continue to go up during COVID? Because in most cases, we've seen rents soften through COVID. What has Millennium 3's experience been?
It's been pretty static. I would say that over the last year, there's been properties that we've seen that have had gains. There's been properties where we've said, as I've mentioned, that kind of strategy going into it of we'll work with somebody. Anybody who wants to come and lease space, we'll give them a couple months of free rent, or maybe give them their first year, their lease rate $1 less than what we would have expected pre-COVID. It all comes down to the negotiations. From an asking rate perspective, our rates are still pretty consistent with what they were pre-COVID. It's in the negotiation of it. We might make a small concession, make a small sacrifice for year 2020 to the benefit of 21, 22, 23, 24, having much higher occupancy through the portfolio, right? One of the number one ways that we see an increasing in rents is there's nothing else available in that particular property or that particular neighborhood, it really helps you raise rents slowly but surely. Now, rents will peak out as it relates to construction costs and the arbitrage there between new builds and existing properties. But that is definitely a factor that helps us increase rents. Is when occupancy is high, you have a stronger ability to increase rents for everybody. So our focus through 2020 was definitely on occupancy, making short-term concessions if it was necessary. But even through 2020, properties that had high occupancy or full occupancy, as tenants were coming up for renewal, many of them saw rent increases for their next renewal term as well.
Okay, great. Next question. Who manages these properties?
So we have our own subsidiary property management company. So that's part of the strategy, is the more things that you can keep internal, the better it is, right? And that's one thing that we had saw, that through COVID-19, government programs, they'd be announced and information would come out in another 3 weeks or a month. And then it took another 2 weeks before people could apply. So a lot of the government supports were there for people in the long term, but not the short term, right? When you're a hairdresser or a massage therapist or a restaurant and your doors closed in mid-March, you had no revenue coming in. Like, some of those businesses could pivot, like restaurants, to skip the dishes and whatnot. But a lot of them were very concerned that they didn't have the financial backing to last more than maybe another month or two. So because we have our own subsidiary property management company, it was a very short discussion and kind of time to get decisions made to, hey, this tenant is looking for a 3-month rent deferral. What can we do for them? It would come to us via our own subsidiary company. Same day decision would be made on that tenant at the Millennium 3 level to what sort of support we can offer them. I think having our own subsidiary property management company has been a strength through COVID-19.
Sure. Okay, great. Thank you. Gerald, I've been very involved in investing in and raising capital for Millennium 3 over the years. And there are a number of interesting tax strategies that could be used. Could you talk about a high income and a low income earning spouse and how they might use Millennium 3?
Absolutely. I think it's one of my favorite investment strategies where it's suitable and where it applies. If you have, looking at it from the household perspective, you have one person that's out making a significant portion of the family income and the other person that's staying home, whether it's just a small business or they just chose that within their family, that's the dynamic that they're going to do. You can see a very interesting strategy in the difference between the tax deduction now and the income later. So in the strategy that I'm about to describe here, the higher income person would buy the investment, use the tax deduction. So let's just assume they're in the highest tax bracket in their province. I don't even need to pick a province. It's probably about 50% is what they're paying, right? So half of Canadian provinces have that level of taxation. Now they get to use the tax deduction at that maximum level to save, but down the road, this starts producing income, right? Like, that's the whole point, is these are income producing real estate investments. They're going to provide an income stream down the road. That income stream is also going to be taxable from the government's perspective. Prior to it getting to its fully paid out status, what we see clients do is one spouse will actually sell the investment to the other spouse. So there's an optimal time kind of between the 3rd and 5th year typically where somebody can sell it. It somewhat minimizes their personal capital gain on it, but now the revenue production in the new owner's, the spouse's hands, will be at a much lower tax bracket. So again, if you had clients even at a relatively small tax bracket of 30%, that's a 20% gap there that you could be saving in your kind of tax bill if the strategy is appropriate and works for the client. For our clients that buy 1 or 2 units, that could be a savings of $1,000 per year. For clients that buy 10 or 15, that can be pretty significant on an after-tax basis employing that strategy.
Okay, and how would one use a similar type of strategy between a corporate and personal situation?
Yeah, that's an interesting strategy there as well for clients that kind of, they have income in a corporation that they're wanting to shelter. If it's investment income, with some of the new TOSI rules and whatnot, you can only have so much investment income before it starts to claw back your small business exemption. So a lot of our clients are buying investments corporately, I should say, using the tax deductions there, but then drawing out the investment. So it's in that same kind of 3rd to 5th year perfect kind of window. You draw out the investment with a draw in kind, or you buy it from the corporate. There's a number of different ways that portion of this can go depending on the actual nature of the corporation. But effectively, you're getting the unit now out of the corporation before it starts producing its taxable income and creating further problems in the corp with having investment income. So then you draw it out to your personal name. It's typically taxed at a more advantageous rate there once it's out of the corp. So again, focus the tax deductions on the corp where you need it, and then pull the investment out personally and get the income from it there.
Great, thanks. Now, of course, we don't give tax advice at Raintree, but we will certainly work with your tax advisor to make sure they've got all the information needed so that they can give you appropriate advice on how to structure the purchase of Millennium 3 units so that it works best for you. Gerald, I've been to the Millennium 3 offices a number of times over the years, and one of the things that has struck me is you guys do everything there. So the accounting is internalized, the property management is internalized, the distribution of is internalized, the underwriting of new properties is internalized. You guys do everything in-house. And it's a little bit like walking into an office building from the 80s. There's a lot of paper and a lot of binders and a big photocopy room. How does this reflect on the type of assets you own and the way that you manage them?
Yeah, I think that all the things that you're saying are exactly right, that it matches the investment style. The investment style is slow, conservative. It's that kind of set it and forget it type investment strategy. We're a similar style company, right? Data security and all these newer things of digital information. We're in those spaces where we have to be, but the more information that we don't digitize, we're certainly more comfortable in that. We still send out physical checks to investors. So we know it's easier to not cash a check and to have things go automatically into your account, but there's just certain ways that we will join the digital revolution at some point in the future and as things evolve in the company. But I think there is a comfort in that, as you described, when yourself and Peter Kincaid came to our office, when he asked to see the financial reporting for one particular partnership, our VP of accounting went down to our file storage and physically brought the banker's boxes with that information and put it on the desk. It really does speak to the fact that we are an internal company, that the more we keep internal, the less challenges, the less you're out exporting, you're increasing your costs, all those kind of considerations we're comfortable being an old school company because we're an old school investment style. We're buying and holding real estate. Like, I don't know if there is an older investment style than just buy and hold. Our investment strategy and the way our investments work, it still works well in that kind of using paper and holding on to records for as long as you need them, which in our case can be a lot of years.
Great. Thanks. Well, listen, Gerald, that wraps up our questions for today. I want to thank you very much for your time. It's always a pleasure seeing you. To all the participants, thank you for your involvement and questions. And if you do have any follow-up, please just be in touch with your Raintree Financial Solutions advisor or contact our head office and we'll be happy to get someone in touch with you. Thanks and have a great rest of the day.
Thanks.